Long before most people become financially stable, they begin believing that wealth belongs to a different category of human being. Someone smarter, more connected, more talented. Someone who entered the market earlier, inherited advantages, built a successful company, or earned an unusually high income. Modern culture reinforces this belief constantly because wealth is usually presented through visible extremes. Luxury homes, dramatic success stories, viral entrepreneurs, traders turning small accounts into fortunes, celebrities buying assets worth more than entire neighborhoods. The result is psychological distortion. People begin associating wealth creation with exceptional events rather than ordinary systems repeated over long periods. But historically, a large percentage of long-term wealth has not been built explosively. It has been built gradually. This becomes easier to understand once investing is viewed less as a shortcut and more as a system that converts time into productive economic force. Most people focus almost entirely on income because income feels visible and emotionally immediate. Yet income alone rarely creates lasting financial security unless part of it is repeatedly transformed into ownership. That distinction matters enormously. A salary is active cash flow connected to continuous labor. Investments are accumulated productive assets capable of generating future value independently. One depends heavily on present effort. The other gradually reduces dependence on future effort through compounding. This is why long-term investing changes average lives more powerfully than most people initially realize. At first, the process appears almost unimpressive. Someone contributes modest amounts monthly into diversified long-duration assets. The account grows slowly. The numbers feel small relative to daily life expenses. Years pass without dramatic visible transformation. Emotionally, it can feel like almost nothing is happening at all. But financially, something extremely important is beginning beneath the surface. Compounding systems reward consistency disproportionately over time. Inside this equation is one of the most misunderstood forces in economics. Future value does not grow linearly because investment returns themselves begin generating additional returns. Early growth feels weak because contributions dominate the portfolio. Later growth accelerates because the accumulated asset base becomes large enough for compounding itself to become economically meaningful. This delay creates a major behavioral challenge. Human psychology evolved around immediate survival environments where quick feedback mattered. People naturally expect visible progress shortly after effort. Modern investing violates that expectation. The first years often look emotionally disappointing despite being mathematically essential. A person investing $200 monthly may see modest growth initially. Then years later the account begins growing by thousands annually. Eventually the portfolio may gain more from investment growth than from new contributions themselves. That is the moment compounding shifts from abstract theory into visible reality. Most people underestimate this transition because they quit emotionally during the slow stage. The modern economy makes this even harder because consumer systems compete aggressively against delayed gratification. Every platform encourages present consumption. Fast shipping. Instant entertainment. Buy now pay later financing. Algorithmic advertising. Lifestyle comparison through social media. The economic system continuously pulls attention toward immediate emotional rewards while long-term investing often feels invisible. This creates an asymmetrical psychological battle. Spending produces immediate sensory feedback. Investing often produces delayed abstract outcomes. One feels emotionally rewarding today. The other feels economically rewarding later. And yet over decades, the cumulative consequences become extraordinary. Someone consistently investing over 20 or 30 years is not merely building an account balance. They are gradually purchasing future optionality. More flexibility. Lower vulnerability. Greater control over time. Reduced dependence on unstable labor conditions. The portfolio slowly becomes a form of stored economic resilience. Historically, this pattern transformed entire social classes. Industrial-era families who reinvested profits rather than consuming everything immediately often accumulated productive ownership across generations. Farmers purchased additional land gradually. Small business owners expanded operations incrementally. Merchant families reinvested trade profits repeatedly. In nearly every economic era, wealth accumulation depended heavily on consistent reinvestment across long periods rather than isolated financial events. Modern investing platforms simply democratized access to the same mathematical principle. The deeper shift is psychological. People who invest consistently begin experiencing time differently. Instead of viewing years purely as aging, they begin viewing years as productive multipliers. Each additional year strengthens previous years. Past contributions continue working quietly beneath the surface regardless of daily activity. Time itself becomes economically useful. That identity shift changes behavior in subtle ways. Someone focused entirely on consumption evaluates money primarily through lifestyle expansion. Someone focused on ownership evaluates money through future productive capacity. The first mindset asks what money can buy immediately. The second asks what money can continue producing over time. Neither perspective feels dramatic during ordinary months. The divergence becomes visible later. This is why many financially resilient people appear surprisingly ordinary externally. Long-term investing often lacks visible signals during accumulation phases because productive ownership compounds quietly. Meanwhile, high-consumption lifestyles frequently appear wealthier than they actually are because visible spending creates stronger social impressions than invisible investing. Modern society rewards visible consumption socially while rewarding invisible ownership financially. That tension shapes enormous amounts of modern financial anxiety. People compare lifestyles while remaining blind to balance sheets. They compare vacations, cars, apartments, and consumption patterns while overlooking debt levels, savings rates, ownership structures, and investment duration. Yet long-term investing changes live specifically because it compounds beneath visibility. And importantly, the transformation is often gradual enough that the investor barely notices it happening in real time. A portfolio that once felt insignificant eventually begins producing meaningful annual growth. Economic stress gradually decreases. Financial emergencies become more manageable. Career decisions become less desperate. Optionality expands quietly year after year. The most powerful part is that none of this requires financial perfection. Many people delay investing because they imagine wealth building requires extraordinary income, flawless discipline, or constant optimization. In reality, long-term investing rewards persistence far more than intensity. Small consistent investing behavior maintained across decades often outperforms short bursts of extreme financial motivation followed by inconsistency. The system values duration. This is why average lives can change so dramatically through long-term investing. The mathematics of compounding amplify ordinary behavior repeated consistently for long periods. Small contributions become large asset bases because time continuously multiplies previous progress. And perhaps the strangest part is that the process often feels boring while it is working most effectively. No dramatic breakthrough. No sudden transformation. No cinematic moment where life changes overnight. Instead, ordinary contributions continue month after month while compounding quietly reshapes future possibilities beneath the surface. Eventually the investor realizes something important. Financial freedom rarely arrives as one explosive event. More often it arrives as accumulated optionality built slowly enough that almost nobody notices the transformation while it is happening.